Walmart, the latest company to move its dividend up. Pay it early to avoid big tax hikes triggered by the fiscal cliff, maybe. Brian Shackman has details on that. Brian?
You know, Bill, by now you know the drill. If we go off the cliff, tax rates on dividends could swing from 15% to about 40%. That possibility enough for a lot of companies to either issue special dividends or move up dividend payout dates, which is exactly what Walmart announced. Instead of paying out early in 2013, the 40-cent dividend will be payable on December 27th. And the company was crystal clear why they did it, saying, quote, it recognized that there are complex fiscal and federal tax rate issues that may not be resolved in the next few weeks, despite the ongoing good faith negotiations between the administration and Congress to resolve details related to the fiscal cliff. You might recall also casino magnate Steve Wynn didn't wait either, announcing last month a $750 million special dividend. That was before the election. Speaking of anticipating, Goldman Sachs wrote about this early in the fall, actually naming Wynn as a candidate for this. They also noted it's more common for these things in Q4 in general, and that companies who use these payouts perform better directly after in a 2-day span and over a 3-month period. Goldman didn't just nail it on Wynn, they also called it with Franklin Resources, TransDigm, and Western Refining. Of course, people talking about price action and dividend players now will also be interesting to watch them in the new year if no deal is made. And of course, Bill, Walmart up about 1.5% today. Back to you.
All right, Brian, thank you very much. Let's talk more about this. Many expect investors are going to see a lot more of these special dividends ahead of the looming fiscal cliff. But is it wise for companies to do this or for investors to try to buy stocks based on guessing what the dividend tax treatment is going to be come January 2?
With us is Lee Munson of Portfolio Asset and CNBC contributor Michael Farr. Michael, you don't think this is a good idea, these companies bringing the money forward? Why not? Why not help out an investor? You know, the taxes probably are going to be higher regardless come January 1 next year. Why not get the money early?
I don't know, Michelle, that it's a bad idea to bring the money forward. I mean, if you take the money out of, like, Wynn Resorts and you take the $750 million out, the $750 million, we hope, if you believe in the trickle-down economics, will get back in the economy. But that's $750 million in cash that Wynn Resorts doesn't have internally to go out and make other investments and grow.
Hold on 1 second, Michael. We got a problem with your microphone. We're going to get that fixed, and then we're going to go to Lee first.
I think he said something, but we'll get back to him on there. Lee, you argue investors should not be playing into these special dividends. I mean, we don't know what the tax sheets are going to be, right?
No, we don't know what they're going to be. But hey, listen, I thought the Walmart and the Steve Wynn is just a perfect setup. Walmart is it's a no-brainer. They just move it back a few days. I mean, they don't need to really know anything. I mean, it's immaterial. But Steve Wynn, now that's what we really want to ask Steve. Hey, listen, do you just want to save $20 million on taxes? Are you that secure that your credit's going to be so great that you're going to be able to borrow next year if you need that cash? Or do you want to ask Steve Wynn, do you not have anything to invest in because 2013 is going to stink? Those are the questions that I want to ask. I think giving money away, I think it's great. Why should corporations keep all this cash, make them lean and mean?
Thank you.
The way you're dividing it really basically is if you were going to give the money anyways, why not move it up? But you question whether they were going to in the first place.
Well, and here's the thing, Michelle, that bothers me a little bit. It's not going to be until next year that we're really going to know, did that CEO, if you're a CEO, think about it. You get an out. You get to say, I'm going to give this money back so the tax man doesn't steal it from you, versus saying, I'm unsure about what my CapEx is going to be next year because of a European recession. That sounds weak. That sounds like you don't know how to invest money. But to say it's to save taxes, hey, you got pressure off of you.
I think we've got Michael's mic fixed. Yes.
How about this? Is it working?
Hello there.
Hot
yes.
diggity dog. Hi, guys.
So tell us again why you don't think it's a good idea.
I was brilliant before, by the way. I'm so sorry.
We wanted word for word.
I said most everything that Lee just said. But the thing that I would add at this point, too, if you're an individual investor, and even if you're one of these big Steve Wynn bigwigs, I've seen more people make really profoundly stupid mistakes by making investment decisions based on tax ramifications. I mean, it'll screw you up over and over again. If you have a good investment, you stick with a good investment. It doesn't change just because the tax rate changes. Yes, if you go from the 20% to 15% up to 46 point something percent, 43 point something percent. I mean, that's a big deal on dividends and other things. But if you have a company that's growing earnings and making good investments, those companies you stick with. So Lee's point I thought was really good about the idea that, you know, you have to question, does the company have something better to invest in, or do they just need the cash?
But if I'm somebody who's living off these dividends, I rely on this income, and my taxes may go from 15% treatment of that dividend income to 40% next year. Am I hurting myself by taking that early dividend, even if it doesn't go to 40% next year, Michael?
I don't think you ever hurt yourself by taking a little cash off the table, and if you do that, I think more the question is, you don't have a lot of choice. I mean, yields stink. Dividend yields, even though that they're high relatively to bonds, they're still no good for folks relying on income, and the tax burden we hope on that middle-class investor is not going to go up. But by and large, if you can take the cash at a lower rate and you have something to do with it, that's not a bad thing to do.
All righty, guys.
Very good.
Lee and Mike, we have some consensus somewhere in there.